next guest has been warning about how that could impact the economy if interest rates stay at the level where they are today. It's one of the considerations for him, believing we could see a rate cut in this country as early as April. Royce Mendes is a managing director and head of macro strategy at Desjardins, and he joins us this morning. Royce, give us your updated view on Canada's mortgage market. We got that indication that we may have peaked in interest rates. It's still unclear, though, on how the Bank of Canada is going to approach interest rates for the rest of the year. What are your takeaways?
Well, I think the Canadian economy is already feeling the pain of higher interest rates via mortgage renewals. It's just that it's been papered over by the explosive population growth that we saw over the past year or so. And so while the economy has been stagnating and not in outright recession, that's really the result of population growth. Canadians who have been renewing mortgages have already been diverting a lot of income and then spending away from businesses in Canada and in the economy in Canada and now towards debt service. I expect that as we move forward this year, we're going to see population growth slow, just naturally because we don't have really anywhere to house these people, but also more so because of government mandated policies. And so we won't have that extra boost to GDP, and we're going to see the cumulative effects of these mortgage renewals start to show up a lot more clearly in the data. And as we move forward, we expect that the economy is going to dip into at least a mild recession this year. And I think you can see from the way the Bank of Canada is positioning itself, it's moving towards a more dovish stance. I don't think anyone should have expected them to come out and say, then we're going to be cutting interest rates in the next few months. They had to move away from a hawkish bias now to a more neutral bias. This is a stepping stone. But if the data continue to deteriorate on the real economy, and hopefully if the data shows some progress on inflation, I think they could be cutting rates as early as April, as you said.
So, and your comments come after we heard from another guest who was sort of positioning mid-year as a fair point to be thinking about interest rate cuts. And what's the determining factor for how aggressive the bank becomes in a so-called pivot? If they decide to cut rates and then they commit to that, what's the math they have to consider, given your concerns about where the economy is and could be because of our exposure to the housing market through mortgages and that kind of stuff?
In my view, if they start a little bit earlier, it gives them the opportunity to be more gradual. I think there are some economists out there who have a later start date for interest rate cuts, but then they might have the Bank of Canada cutting more than 25 basis points at a particular date. I think that's a more, almost a more aggressive way of moving to a more neutral level of interest rates in this country. Starting earlier also means that, there won't be a bunch of Canadians that will have renewed interest rates, renewed their mortgages in a higher interest rate environment. Every month, 1.5% of mortgage holders in this country, which is tens of thousands of people, renew a mortgage. And so, waiting a few months can mean a big difference for a lot of Canadians. And the economy, as I said, is not only facing the challenge from mortgage renewals, population growth, the one driver of economic activity over the past year, is going to be slowing. And then we do have, we're starting to see struggles in the business sector. Insolvencies are rising. We know that a lot of the CEBA loan recipients didn't meet the deadline, didn't pay it back, and they face a very uncertain future. And we just saw a report this morning on the non-farm payroll report in Canada for November, where there were significant job losses and wage growth slowed. So I think that, all the signs are that the bank is moving towards cutting rates. The question is about when. My view would be that they should start a little bit earlier so they can take a more gradual and patient approach.
One thing that came up, Royce, when we were covering the Bank of Canada news yesterday was that you go back a year ago when they had started to indicate maybe a more dovish stance. They weren't ready to begin cutting interest rates or anything like that. But there was a view in our housing market where, let's face it, there's a lot of capital in our housing market, and a lot, to your point, there's tight supply, people interested in finding the right opportunity to get in if they need to get in. And so they're looking for these indications. So some would say As soon as there's an indication from the Bank of Canada that rates are going down, that's going to overheat our housing market once again. You're going to see those other inflationary effects tied to housing that the Bank of Canada governor was talking about, and we're going to be in this complicated cycle or circle that people are worried about. What's your sense on that?
I think that's a real risk. That's very reasonable to worry about, once the Bank of Canada signals that it's going to cut rates, or once it actually cuts rates, that, the Canadian housing market picks back up. But we're in a different situation than we were a year ago. We've been through a long period of absolute stagnation, and in some periods we've actually seen negative GDP growth. We're starting to see the labor market turn over. We're seeing companies start to shed employees instead of scrambling to hire them during labor shortages. We've already seen a long period of people having renewed mortgages at these higher interest rates, so they don't have income to go out and spend in the economy, even if rates come down a little bit. So I think that the risks to the downside actually outweigh the risks to the upside from a resurgence in housing. And realistically, even if rates start to come down gradually, they're still going to be higher than they were 5 years ago. And that means that people will be still renewing at higher, and in some cases much higher, interest rates than they took their mortgage out at. For 30 years in this country, generally speaking, people renewed their mortgages at a lower rate than they took it out 5 years earlier. This is really the first time we're seeing a sustained period where mortgage renewals mean a positive payment shock. And, for some people, particularly those variable rate mortgage holders, a very large payment shock is on the horizon. And so I see that as a very clear downside risk and a very big downside risk. And so you never can conduct monetary policy without having both upside and downside risks. But I see the downside risks in this case as outweighing, the upside risk of potentially reigniting the housing market. And if it did, and they're moving gradually, well, then they can take a few meetings off and assess where they are and see what they want to do next.